Chapter 2, Asset Classes and Financial Instruments. So the process of building an investment portfolio begins with deciding how much money to allocate across a broad class of assets, such as safe money market securities or bank accounts, longer-term bonds, stocks. So each broad asset class contains many separate security types. Financial markets are traditionally segmented into money markets and capital markets. Money market instruments include short-term marketable liquid, low-risk debt securities. They're also called as cash equivalents or cash for short because they are actually cash. They have not invested anywhere for longer term. So there are three segments in which these are divided into: longer term debt markets, equity markets, and derivative markets, where we have options and futures. So here are some types of financial indices. So money market has Treasury bills, certificate of deposit, commercial paper, bankers' acceptance, euro dollars, repos and reverses, federal funds, broker calls. And in the bond market, we see Treasury bonds, federal agency debt, Muni Bonds, corporate bonds, and mortgage-backed securities, which basically caused the 2008 meltdown of the financial market. Then we have equity markets, the common stocks and preferred stocks. Then we have various indices like Dow Jones Average, Standard and Poor indices, bond market indicators, international indices. And then for derivative markets, we have the options, futures, and swaps. The money market is very short-term, highly marketable debt security. They trade in large denominations and they are out of reach for individual investors. Money market mutual funds are easily accessible to small investors. So the first thing is the US Treasury Bill, or a T-bill for short. At the bill's maturity, government pays the investor the face value of the bill. They have maturity periods of 4, 13, 26, or 52 weeks. So unlike most money market instruments which sell in minimum denominations of $10,000, $100,000, T-bill sells in minimum denominations of only 100. So here are some Treasury bill listings that came from the US Treasury. So in 2017, we saw a lot of treasuries at different values. So the first two yields are reported in the bank using the bank discount method. This means the bill's discount for its maturity or face value is annualized based on a 360-day year and then reported as a percentage of face value. For example, asking for a highlighted bill maturing in 177 days, and the yield under the column label asked is given as 0.895. So asked yield is this, asked is this, and the asked yield is this. And then you can track the changes. And then you have the CD, which is like putting money in your local bank. So CDs are also marketable, although banks will not buy the CDs from other banks for more than 3 months. So there's also something called commercial paper. Typical corporation is a net borrower of both long-term and short-term funds. Short form is CP. CP maturities can range up to 270 days and denominations in multiples of $100,000. CPs are fairly safe assets. Historically, CP was issued by non-financial firms, but recently there is something called asset-backed CPs issued by financial firms like banks. The short-term CP typically is used to raise funds for issuing firm to invest in other assets, most notoriously subprime mortgages, which was the cause of 2008 meltdown. And these assets in turn were used as collateral for the CP, so they were called asset-backed. And then many subprime mortgages began defaulting. So the bank found themselves unable to issue new CP to refinance their positions as the old paper matured. The next one is the banker's acceptance. Starts as an order to a bank by a bank customer to pay a sum of money for a future date, typically within 6 months. At this stage, it's like a post-dated check. At this point, the acceptance may be traded in secondary markets, much like any other claim on the bank. Bankers' acceptance are considered very safe assets. Then we have the euro dollars. By locating outside of the United States, these banks escape regulation by the Federal Reserve Board. These are not European banks. They're just like they are outside. They are dollar-denominated deposits at foreign banks or foreign branches of American banks. Most of them are for very large terms and less than 6 months maturity. Then you have the concept of a repo or a repurchase agreement, RPs for short. Dealer sells security to investor on an overnight basis with the agreement to buy back those securities next day at a slightly higher price. Increase in the price is the overnight interest rate. The term repo is essentially an identical transaction except for the term of the implicit loan can be 30 days or more. Repos are considered very safe. A reverse repo is the mirror image of repo. The dealer finds an investor holding government securities and buys them with an agreement to resell at some higher price. Broker calls individually who buy stock on margin, borrow part of the funds to pay for the stocks from their broker. Broker in turn may borrow the funds from a bank, just like we are seeing now with the GameStop deal. Various brokers had to get short-term loans of $1 billion or more. Then you have federal funds. Just like we maintain deposits at the bank, bank maintains deposits of their own at the Federal Reserve Bank. Each member of the Federal Reserve System is required to maintain a minimum balance in a reserve account. The required balance depends on the total amount deposits of the bank's customers. They are called Fed funds. Other banks, primarily big New York and other financial center banks, tend to have a shortage of federal funds. In federal funds market, banks with excess funds lend to those with a shortage. These loans, which are usually overnight, are arranged at a rate of interest called federal funds rate. Today, many large banks use federal funds in a straightforward way or one component of their sourcing. Then we have the Libor Lender interbank offer rate, short-term interest rate quoted by European money market and serves as reference for a wide range of transactions. So these declined substantially in recent years. Libor still remains a crucial benchmark for many financial contracts. A corporation might borrow at rate equal to Libor plus 2 percentage points. Many of the loans, mortgages, derivative contracts are tied to Libor. There is something called Euribor, European Interbank Offer Rate, or Tokyo Interbank Offer Rate, and they're quoted in major currencies like dollar, pound, yen, euro. British regulators are proposing phasing out Libor by 2021, replacing it with SONIA, Sterling Overnight Interbank Average Rate. US regulators have proposed the US dollar Libor be replaced by rate on repurchase agreement on Treasury securities. So Libor is slightly going away. The 2012 scandal involving and fixing of Libor deeply shocked these markets. So here is a little bit detail of a $350 trillion of derivative contracts have payoffs tied to Libor. So Libor is quoted for loans in 5 currencies: dollar, yen, euro, UK, pound, Swiss franc. Libor is not a rate at which actual transactions occur. It's just a survey of estimated borrowing rates, and this has made it vulnerable to manipulation. Several large banks are asking to report the rate at which they claim they can borrow in an interbank market. Over time, several problems surfaced. Many banks understated the rates at which they claimed they could borrow in an effort to make themselves financially stronger. Libor did not seem to reflect the correct market conditions. Majority of the submissions were unchanged, and Libor spread showed surprisingly low correlation with other measures of credit risk. Even once the market came under scrutiny, it emerged that participating banks were colluding to manipulate their Libor submissions to enhance profits on their derivative trades. Traders used email and instant messages to tell each other whether they wanted to see higher or lower submissions. Members of this informal cartel essentially set up a favor bank to help each other move the survey average up or down depending upon their trading positions. More than 6 billion of fines have been paid. Deutsche Bank, UBS, Royal Bank of Scotland, Repo Bank, and SocGen. The Federal Appeals Court in 2016 ruled that private lawsuits may proceed. Several reforms have been suggested and some have been implemented. British Bankers Association, which until recently ran the Libor survey, yielded responsibility for Libor to British regulators. More substantial proposals would repair the service rate with one based on actual verifiable transactions. Sterling Overnight Internet Bank and the Treasury securities will replace Libor pretty soon. So yields on money market instruments, although most money market securities are low risk, they are not risk-free. Securities of money market promise yields greater than those default-free T-bills, at least in part because of their greater relative risk. Investors who require more liquidity will also have lower yields on securities such as T-bills and can be more quickly and cheaply sold for cash. When there were energy price shocks associated with OPEC disturbances, the stock market crash in '87, collapse of long-term capital management in 1998, and financial crisis of 2008-2009, you'll see that the TED spread, the difference between Libor and Treasury bill rate, also peaked during the financial crisis. Money market funds and mutual funds that invest in money market instruments have become major sources of funding to that sector. Money market funds are mutual funds that invest in short-term debt instruments that comprise money market. Because of the conservative investment profile, extremely low risk, funds almost always maintain share value at $1 past all investment earnings to their investors as interest. Until 2008, only one fund had bought in the buck, suffered losses due large enough to force value per share below 1. When Lehman Brothers filed for bankruptcy, several funds that invested in CP suffered large losses. Money market funds were at risk in the credit crisis, led to wave of investor redemption, similarly to a run on the bank. US Treasury announced to make federal insurance available to money market funds willing to pay an insurance fee. This would be similar to FDIC bank insurance. However, the turmoil on Wall Street spilled into the main street. Companies became reliant on money markets as major source of short-term finance, ranging from salaries to inventories. In the panic and stabilize the market, federal government decided to guarantee investments in money market funds with a potential liability of up to $3 trillion. US regulators have since approved a series of reforms to reduce risk of the run on the funds. Institutional money market funds are required to float the prices of their shares based on value of their assets rather than maintain the fixed dollar value. This limits the incentive during a crisis for investors to compete to be the first to withdraw funds. In addition, funds will have authority to either limit redemptions or impose redemption fees of up to 2% if the fund falls by more than 30%. The bond market is composed of longer-term borrowing or debt instruments, and those that trade in money market includes treasury notes and bonds, corporate bonds, Muni Bonds, mortgage securities, etc. They are fixed income capital market because most of them promise either a fixed stream of income or stream of income that is determined according to a specified formula. These formulas can result in flow of income that's far from fixed, hence the term fixed income is probably not fully appropriate. Then we have treasury notes and bonds. T notes are issued with original maturities for 10 years. Both bonds and notes may be issued in increments of $100, but far more commonly trade in denominations of 1,000. Both bonds and notes make semi-annual interest payments called coupon payments. So here in this example, the highlighted bond matures in 2020. Coupon income or interest paid by bond is 1.5% of par value. For a $1,000 face value bond, $15 in annual interest payments will be made in 2 semi-annual investments. The bid price of the highlighted bond, which matures, is $100, 30.3047. So it is 39 basis points. This minimum tick size or price increments in Treasury bond market is generally 1 over 128 of a point. The yield to maturity report in the last column is measure of annualized rate of return to an investor who buys the bond for the ask price and holds it until maturity. It accounts for both coupon income as well as difference between the purchase price of the bond and final value of $1,000 at maturity. We discuss this yield to maturity in detail later. Inflation protected Treasury bonds. Around the world, governments of many countries have issued bonds that are linked to index of cost of living. Inflation-protected Treasury bond, called TIPS, Treasury Inflation Protected Security, is adjusted in proportion to increase in consumer price index. Therefore, they provide constant stream of income in real inflation-adjusted dollars. Federal agency debt. Some government agencies issue their own securities to finance their activities, like Federal Home Loan Bank, Federal National Mortgage Association, or Fannie Mae, Government National Mortgage Association, Ginnie Mae, and Freddie Mac, Federal Home Loan Mortgage Corporation. Although the debt of federal agencies is never explicitly insured by federal government, it has long been assumed that government would assist the agency nearing default. With both firms on the brink of insolvency, the government stepped up and put in both a conservatorship, but did not agree to make good on the firm's bonds. Then there are international bonds, like a euro bond dominated in a currency. They could be euro-yen bonds, yen-dominated bonds sold out of Japan, outside of Japan. Bonds that are issued in foreign currency. Many firms issue bonds in foreign countries, but in the currency of the investor. Yankee bond is a dollar-denominated bond sold in the US by a non-US issuer. Samurai bonds are yen-denominated bonds sold in Japan by non-Japanese issuers. Muni bonds, similar to Treasury and corporate, interest income is exempt from federal income taxation, exempt from state and local taxation in the issuing state. Capital gains, however, must be paid on municipal bonds mature or are sold for more than investors' purchase price. General obligation bonds are backed by full faith and credit. Revenue bonds are issued to finance particularly projects that are backed either by revenues from the project or by municipal agency operating the project. Typical issuers of revenue bonds are airports, hospitals, turnpikes. Industrial development bond is for commercial enterprises. So you see in this, tax-exempt debt is into $3 trillion for general obligation and about $500 billion for industrial revenue bond. Like Treasury bonds, municipal bonds vary widely in maturity. Other Muni debt may be long-term, maturities range up to 30 years. The key features of a Muni bond is tax-exempt status. If you let T denote the investor's combined federal plus local marginal tax rate and R taxable denote the total before tax and of return available on taxable bonds, the R taxable 1 minus T is the after tax rate available on those securities. If the value exceeds the rate on municipal bonds, investor does better holding taxable bonds. Otherwise, munis are better. Equivalent taxable yields corresponding to various tax-exempt yields. So marginal tax rate of 20%, tax-exempt yield is given in the table here. Marketing literature for tax-exempt Muni bonds show this table frequently. to entice people to buy Muni Bonds, which are targeting less tax rates. The default risk on this bond may be roughly comparable in many periods, but certainly will fluctuate over time. Ratio of yields on Muni debt to corporate BAA rated debt. For most of the last 60 years, ratio of tax exempt to taxable yields fluctuated around 0.7. Investor whose combined tax rate, federal plus local, exceeds 1 minus 0.7 or 0.3 or 30% will derive a greater after-tax yield from municipals, which rules out basically majority of the people in America. Very few people are in that 30% tax bracket. Corporate bonds are by private firms like Tesla or Microsoft. They're much like treasuries. Default risk is real consideration purchase of corporate bonds because company can go belly up. Then there are unsecured bonds like debentures. So in terms of secured bonds, we have specific collateral backing them in the event of bankruptcy. Unsecured, there's no collateral. Debentures. Corporate bonds sometimes come with options attached. Callable bonds give the firm the option to repurchase the bond from the holder at a stipulated call price. Convertible bonds give bondholder the option to convert each bond into a stipulated number of shares. So a callable bond can be called by Tesla back. A convertible bond can be converted by a end customer into common stock. Then you have mortgage and asset-backed securities. Ownership claim in a pool of mortgage or obligation that is secured by such a pool. Most pass-through traditionally comprised conforming mortgages, which meant that the loans had to satisfy certain underwriting guidelines, standards for creditworthiness of the borrower before they could be purchased by Fannie Mac or Freddie Mae. Large amount of subprime mortgages made it to financially weaker borrowers were bundled and sold by private label issuers. And that caused the 2007-2008 collapse. So the government-sponsored enterprises were encouraged to buy subprime mortgage securities. Loans turned out to be disastrous and trillion-dollar losses spread among banks, hedge funds, and other investors, as well as Freddie and Fannie, which lost billions of dollars on subprime mortgages they had purchased. Starting 2007, though, market in this came down. Few believe that securitization itself will cease because of the improvement in credit standards over a period of time. It's now common for car loans, student loans, home equity loans, and even debt of private firms to be bundled into pass-through securities that can be traded in the capital market. The growth of non-mortgage asset-backed securities is shown in the diagram below. So you see student loans form a larger proportion, equipment, a constant proportion, credit card, a smaller proportion, an automobile keeps fluctuating up and down. As we go on to this next chapter, next section of the chapter, equity securities, common stock known as equity securities. A corporation is controlled by a board of directors elected by shareholders. Members of board are elected at annual meetings. They can be bought and sold freely in one of the stock markets. So there is one interesting thing. Shareholders who do not attend the meeting can vote by proxy, empowering another party to vote in their name. Management usually solicits the proxies of shareholders and normally gets a vast majority of these proxy votes. Thus, management usually has considerable discretion to run the firm as it sees fit without daily oversight from the equity holders who actually own the firm. Characteristics of common stock. Two most important characteristics of common stock as an investment are in the residual claim and its limited liability features. Residual claim is stockholders are last in line to have a claim on the assets and income of the corporation. In liquidation of firm's assets, shareholders have claim to what is left after paying all other claims, like tax authorities, employees, suppliers, bondholders, and other creditors. Shareholders have a claim to part of the operating income left after interest and income taxes have been paid. Management can pay this residual as cash dividends or shareholders to reinvest it. Limited liability that most shareholders can lose in the event of the failure of the corporation is their original investment. That the maximum is their original investment. Or not like owners of unincorporated business whose creditors can lay claim on personal assets, such as houses, cars, furniture. In the event of bankruptcy, corporate stockholders at worst have worthless stock. They're not personally liable for the firm's obligation. Their liability is limited. So here's some of the key trading data for different companies in 2017. The same GameStop has now gone to a much larger amount this past week. The closing price of the stock for G was $29.20. Over 19 million shares were traded on that particular day. Dividend yield is only part of the return on the stock investment. It ignores prospective capital gains, price increases, or losses. Shares in low dividend firms presumably offer greater prospect for capital gains. The PE ratio tells us how much stock purchases must pay per dollar of earnings. Ratio of price to earnings is 27.21, varies across firms. Preferred stock has features similar both to equity and debt. Like a bond, it promises to pay a fixed stream of income each year. In this sense, preferred stock is similar to infinite maturity bond. It also resembles a bond in that it does not give holder voting power. Preferred stock is an equity investment, however, firm retains discretion to make the dividend payments to preferred stockholders. It has no contractual obligation to pay those dividends. Instead, preferred dividends are usually cumulative. Unpaid dividends accumulate and must be paid in full before any dividends may be paid to holders of common stock. Also, tax treatment is different. Preferred stock payments are treated as dividend. They are not taxes deductible expenses for the firm. The disadvantage is offset by the fact that corporations may exclude 50% of the dividends received in the computation of their taxable income. Therefore, they make desirable fixed investments. Even though preferred stock ranks after bonds in terms of priority of its claim to the assets, it often sells at lower yields compared to corporate bonds. This reflects the value of dividend exclusion because higher risk of preferred stock would tend to result in higher yields than offered by bonds. Individual investors who cannot use that exclusion will find preferred stock yields unattractive. Corporations issue preferred stocks in variations similar to that of corporate bonds. They can be callable by issuing form which is said to be redeemable. Then we have depository receipts. Certificates trade in the US markets, ownership in shares of foreign company. Each ADR may correspond to ownership of a fraction of a foreign share, one share or several shares. They are created to make it easier for foreign firms to satisfy US security regulation requirements. Moving on. So you have Dow Jones Industrial Average is one of the index. It also made the indexes of the foreign financial market part of the general news. So we talk of Nikkei in our market analysis. So the DJIA has the 30 large blue chip corporations. Tesla recently entered there. So DJIA was calculated by the average price of stocks. So if there were 30 stocks in one index, you add the price of 30 stocks and divide by 30. The percentage change in DJIA would be percentage change of the average price of the 30 stocks. The value of such a portfolio is the sum of the 30 prices. Because the percentage change in average of the 30 prices is the same, the index and portfolio have the same percentage change each day. Hare Krishna Chandar. We'll be meeting in another half an hour. Is that okay? 4:45 or 7:45 your time.
Hi, Hare Krishna Babuji. Oh, you said 7:45? Okay, thank you.
Thank you.